Welcome back. It is now 7:13 on your Friday morning, and the U.S. economy took a big hit, which we now know shrank over the first 3 months of the year. Well, new numbers out now show the economy dropped at a pace of 1.6% from January to March. So for some perspective on all of this, we are joined by investment advisor Bruce Allen. Bruce, thank you so much. This is such an important topic, and we appreciate you breaking it down for us. Well, let's first start off by the fact that we're halfway through the year. Let's talk about those markets. Are they looking good right now? What are we seeing?
It's the worst start of the year since 1970 for stocks. So
let me rephrase the question. The markets, they looking really bad right now?
Yeah, it's been a difficult first half. So what we've seen, if you look inside the numbers, is that the Dow Jones Industrial Average so far this year is down just shy of 15%. The broader S&P 500 with dividends is down just under 20%, and it did go down further than 20%. Officially a bear market by Wall Street convention, more than 20% is called a bear market or a declining market. And the NASDAQ, the tech-heavy growth stocks, are down over 29%. So the distinction between the Dow and the NASDAQ is that the more tech-heavy names with less dividend payers are being outperformed by the Dow, which has older, more established dividend pay companies. Those are holding up much better.
One thing we've kind of seen to retaliate against what's happening right now is we've seen the Federal Reserve's raising the interest rates. One, can you kind of explain why that happens? And two, what that really means for investors or maybe any of our friends watching at home right now?
So we brought some data about interest rates so far this year in their efforts to cool off the economy and slow down the very white-hot inflation we've got. We've got inflation over 8% right now.
Wow.
Jerome Powell and his colleagues have raised short-term rates, that's the Fed funds rate that they control, from 0.25% to 1 3/4. And Jordan, if we look out over the next 90 days, they're likely to raise rates another 1 1/4%. So that rate could hit 3% by the end of September. The 10-year Treasury bond has also gone up in rates, and that really impacts other loans, as you'll see in a second. They've gone up from 1.5% to over 3%. They've doubled in the first half of this year.
Wow.
And that's caused really havoc in the bond market. And then mortgage rates have risen dramatically as a result of all these rates rising. And that's showing up in that the rates are now almost 6% as opposed to 3 1/4.
Yeah.
That's cooling off the housing market. So all of these interest rates, short-term, long-term, are going up dramatically, and that's having an impact on the housing market and spending.
Certainly. So one thing that Bruce, you and I were talking about is the fact of when you raise the interest rates, one of the reasons that the Federal Reserve does this is they're actually, like you kind of said, they're trying to cool off consumption. They're trying to cool off people buying a little too much and pull back on that. Is it working? Are we seeing that effect?
I think that it's typically what you see is a lag. When the Federal Reserve enacts this policy, you see a lag, and whether that's 6 months or 12 months, a lot of times people talk about the U.S. economy being a gigantic ship at sea, and you don't just stop that ship and turn it. So there's a lag time. What we've seen so far this year, and so I think some of the calls for recessions have been a little bit premature, is spending is up dramatically. Incomes are up. In fact, we saw a couple days ago that private wages are up almost 12%, and while inflation's 8%, we're seeing people making a lot more money than they had.
Wow.
And that means that we have more people working today also. We've seen 2.5 million people get more jobs. So we started with 155 million plus people working in America. Now we're over 158.
Right.
Spending is up because everybody's making money, more people are working, and our unemployment rates are very low. So it's challenging to see how we're in a recession right now.
Okay.
However, looking forward, the key, whether we're going to have a recession or not, lies in the Treasury bond market. If short-term Treasuries, and this may happen over the next 90 days, pay higher interest rates than long-term Treasuries, that is the great predictor, if you will. And that has happened before every recession since 1952. If that happens, we probably ought to talk about, is this going to be a shallow or a deep recession?
All right, we're going to take this big baritone warning very seriously. We'll call you back in should that happen. Thank you so much for breaking that down for us. We very much appreciate it, Bruce.